If I asked for your opinion on the performance of this account, what would it be? We are below level 0. The trend line is consistently downward, so you will most likely think you are looking at a trading account that is losing. It can't be otherwise. It is impossible that the trader of this account is making a profit, right? I imagine you will think that this chart highlights the crucial importance of risk and capital management in trading. Such a prolonged negative trend requires a serious reassessment of the strategy. And what do you say about this? After an uncertain start, the chart shows a clear upward trend, especially in the second half of the observed period. We notice a turning point. Towards the end of April, there is a significant change in direction. From this point on, the performance becomes consistently positive. There is significant growth. In the last month and a half or so, the account has recorded substantial growth, exceeding a 100% return compared to the starting point. The positive performance is sustained over a prolonged period, indicating possible robustness of the adopted strategy. If this trend continues, it could lead to even more significant results in the long term. Do you agree? Now I have a question for you. Which of the two faithfully reflects your ideal market performance? The one on the left or the one on the right? Undoubtedly, you would have answered, the one on the right. The ideal market performance is undoubtedly represented by the chart on the right. This is because it shows a clear upward trend, especially in the second half of the period. This indicates an effective and constantly improving trading strategy. Despite an uncertain start, the trader managed to reverse the trend, suggesting good adaptability and risk management, ending with a performance well above the starting point, indicating a substantial increase in invested capital. This type of trend suggests a sustainable strategy that could lead to even better results in the long term. On the contrary, the chart on the left shows a constant decline, which is absolutely undesirable in a trading strategy. Such a trend would quickly lead to the depletion of capital and is not sustainable in the long term. Obviously, in trading, even the best traders can experience periods of drawdown. However, as a standard practice, the goal of every trader should always be to maintain an overall positive performance in the long term, as illustrated by the chart on the right. Do you agree with this? So you would never question your choice. You are convinced that this equity is better than this one. Actually, what I showed you does not represent the equity of two different accounts. Contrary to what it might seem at first glance, the charts we analyzed do not depict the equity of two separate accounts. In reality, we are observing the performance of a single account managed by one trader. This might seem paradoxical, perhaps even hard to believe, but it is a single account with recorded transactions. Let's analyze in more detail what we are observing. The equity you see constantly in loss, the pink one, represents the accumulated pips throughout the trader's activity. However, in this case, it would be more appropriate to refer to it as pips in loss. The blue line, with its upward trend, represents performance or gain, the percentage earned by the trader during their activity. It shows what the trader has gained despite losing pips in the market. This seemingly paradoxical phenomenon between lost pips and realized profit highlights a fundamental concept in trading. Success in trading does not depend simply on the number of pips gained or market trend identification, but on how these movements are managed and monetized. It's a practical example of how an experienced trader can turn even seemingly unfavorable scenarios into profit opportunities. How is it possible to make a profit despite losing points in the market? This question touches on a crucial concept in advanced trading, often overlooked by most traders. It all comes down to a proportional calculation, which most traders ignore, between what is lost and what is gained during trading activities. In reality, the market provides many more levers for making a profit. The issue is that most traders are unaware of these, as they have always been convinced that improving performance requires predicting market trends. This is a misconception. The main problem is that most traders cling to the traditional paradigm that success in trading depends solely on the ability to forecast market direction. This belief, however widespread, is misleading and limits profit potential. To excel in trading, it is crucial to overcome this limiting mindset and explore more sophisticated strategies that fully utilize the multiple opportunities the market offers, often found in losses. This concept challenges conventional views on trading. Instead of trying to avoid losses at all costs, advanced strategies recognize that losses are a frequent and inevitable part of trading activity. So why not leverage them? The innovation lies in how these losses are integrated and utilized within a more detailed strategy. In this context, losses are not seen as failures, but as recurring events that can be managed and potentially exploited for immediate profits. This approach requires a sophisticated understanding of market dynamics and risk management techniques. The focus shifts from avoiding losses to managing them effectively, turning them from obstacles into potential catalysts for trading success. This change in perspective paves the way for more flexible and robust trading strategies that can thrive in most unpredictable market scenarios. But do you think the trader who achieved over 100% on this account correctly predicted the market trend while trading? Absolutely not. they always lost points in the market. Otherwise, the equity representing the accumulated pips during their activity would show an upward trend correlated with the gain. Instead, we see an inversely proportional trend to the gain recorded. We can see it in this detail. The trader lost nearly 200 pips. I imagine you still find it hard to believe, despite having the account activity available for everyone to see. How is it possible to lose pips and still make a profit if you've always been convinced that to profit in the market, you need to be aligned with the market trend? Here, points are lost in the market and profits are made. How do you explain that? In reality, I could claim the opposite. There are traders who gain pips but lose performance. Paradoxical, right? Look at the performance of this account. There are times when a trader loses points in the market, but applies a technique that helps preserve the account's capital. Despite losing more points in the market than they actually gained, the account balance remains surprisingly stable. And look at what happens here. Now the trader is gaining more points in the market, but losing performance, losing gains, losing money, despite having identified the market trend. This situation represents a critical error in trading management. The trader has the opportunity to accumulate points, a notoriously difficult task, but fails to capitalize on this advantage. The inability to effectively monetize earned points highlights a significant gap in the overall strategy, underscoring the importance of effective management, not just of losses, but also of potential gains. What's the point of working hard in the market if opportunities to make money are lost? How is it possible to lose points in the market and still make money, or to gain points in the market and lose money? Success in trading fundamentally relies on a mathematical relationship between losses and gains that should never be ignored. This concept, however, escapes the attention of most traders. If it were widely understood, there would be less skepticism and disbelief regarding these undeniable results. The common belief among traders is that profit comes solely from consistently following market trends and avoiding mistakes. This simplistic view overlooks the complexity of market dynamics and advanced risk management strategies. In reality, a successful trader knows that it is not necessary to always guess the market direction correctly. Often, they use their mistakes to maximize their market performance. The key element is maintaining a favorable risk-reward ratio, even when facing temporary losses. This more sophisticated perspective paves the way for more effective and realistic trading strategies. Most traders obsessively focus on finding the perfect trading signal applicable in every market condition. This is pure fantasy, and in believing these illusions, they overlook the numerous opportunities the market offers in any scenario. Understanding market direction and correctly interpreting the scenarios that arise is certainly important. However, this knowledge alone does not guarantee success in trading. The real competitive advantage lies in the ability to grow the account balance, even when losing points in the market. This skill, based on sophisticated risk and capital management, can be more profitable and simpler than merely predicting price movements. In essence, trading excellence is not only measured by forecasting accuracy, but by the effectiveness in generating profits in monetary terms, regardless of market fluctuations. Keep in mind, understanding market direction is not wrong. Having tools to analyze the scenarios you face is advantageous. But be aware that knowing all these things does not make you better than someone who, despite losing points in the market, can still grow their account balance. At this point, an important debate arises regarding all these challenges where, to make a profit, you must adhere to specific parameters and rules set by those who ultimately wish to avoid paying your deserved commission if you can still earn money from the market despite limitations and restrictions. Ignore these limiting constraints that educate you in collusive, unfounded, and misleading disciplines. Be free to maximize your opportunities in the market. Be free to make money as you see fit. You can refine your techniques while managing risks. Your problem is not how to make money, but how to obtain it. Learn to distinguish the real problem from the false one that has been ingrained in you. The most effective trading approach involves the freedom to adapt your strategies to the ever-changing market conditions. Your goal is to make money in any market condition by leveraging your own limitations. The key to success lies in developing and refining approaches that dynamically adjust to your trading plans and your own constraints. Only this flexibility will allow you to transform limited financial resources into more substantial capital. The obsession with infallibility and perfection in trading, combined with blind adherence to unverified and unfounded dogmas, often leads traders to miss numerous market opportunities. Only fools apply dogmas that set rules and percentages based on unfounded calculations, without effective tools to understand the cost of their exposure. This attitude results in ineffective and counterproductive trading styles, reinforcing the rule that 90% of traders lose and do nothing to avoid it. Analyzing the presented equities, it becomes clear that investing time and resources in finding increasingly sophisticated techniques to identify market trends is often a futile exercise. These strategies, no matter how elaborate, inevitably fail when faced with the complexity and unpredictability of financial markets. True progress in trading does not lie in the search for the perfect prediction, but in developing flexible and resilient approaches. The goal should be to create a trading style that can generate profits in various market conditions, including adverse ones, regardless of the ability to constantly predict price direction. Market fluctuation is a stochastic process in perpetual motion, meaning price movements are inherently chaotic and difficult to predict with precision. One key factor in Forex is the role of central banks. Central banks, by their nature, must maintain a certain degree of opacity in currency price trajectories to avoid creating a new imbalance while trying to achieve equilibrium. If all market participants could accurately predict a currency's appreciation to a specific level, the equilibrium point would be compromised by their own actions due to the inefficiencies of central banks. This dynamic creates a market environment where absolute predictability is not only difficult, but also macroeconomically undesirable. For traders, this means that the ability to adapt to changing market conditions is often more valuable than seeking perfect forecasts. Price movement can follow one of these three trends: bullish, bearish, sideways. When a trader places a market order, they initially have a 33% chance of aligning correctly with the current trend. This is a crucial point. The probability is 33%, not 50%, as one might intuitively think. If the trader realizes they have chosen the wrong direction initially and then focuses on the remaining two possibilities, the probability of making the correct choice on the next attempt increases to 66%. This scenario illustrates the practical application of probabilistic reasoning, a fundamental aspect of applied statistics in trading that allows traders to maximize their profits even in adverse scenarios. In probability theory, the conditional probability of event A given event B represents the probability of A occurring, knowing that B has already happened. This concept highlights the degree of dynamism needed in one's trading style as new information becomes available. Therefore, it's essential to have the knowledge and tools to apply a dynamic correction to your approach based on the observation of event B. This probabilistic perspective in trading emphasizes the importance of a flexible and adaptive approach. Market participants need to be ready to adjust their strategies based on emerging information rather than relying on a rigid and predetermined method. The ability to correctly interpret market events and adjust one's expectations and actions accordingly is a key element for success in trading. This dynamic approach allows traders to make the most of emerging opportunities while minimizing risks associated with a static or outdated understanding of market conditions. In essence, what I'm highlighting is that a loss is not merely a negative outcome, but represents an untapped opportunity for profit. Here's the paradox explained. Despite losing points in the market, our trader is consistently making money. Most traders are not prepared to capitalize on seemingly adverse market scenarios. In unfavorable market conditions, many traders adopt passive attitudes. Unable to react proactively, they wait for the market to correct the loss generated by their exposure. This inertia often results from two main factors. 1. Lack of adequate market measurement tools. Many traders lack the necessary tools to effectively analyze and exploit adverse market situations. 2. Lack of know-how. There is often a gap in understanding how to turn challenges into opportunities within the trading context. This inability to adapt and respond dynamically to evolving market conditions represents a significant barrier to trading success. A more sophisticated approach would view every market movement, even those seemingly negative, as potential sources of profit if managed with the right strategy and mindset. The key is to develop the ability to quickly reframe one's strategy in response to market conditions, seeing each scenario as an opportunity rather than a threat. If I set a point for each pip lost and lose 10, applying a factor of 2, to recover the value of the 10 lost pips, I need to accumulate half of that. What does this mean for my accounting? The monetary value lost is fully recovered, while the number of pips is only partially recovered, 5 pips gained versus 10 pips lost. If I tripled the multiplier of the risk-reward ratio, I could recover the same loss with 1/3. In this case, earning about 3.33 pips would compensate for a loss of 10 pips. This approach illustrates how a strategic management of your trading plan can optimize loss recovery, allowing you to return to profitability with fewer favorable market movements, even with constant market losses. In conclusion, what happens to my equity? While I lose pips, I am actually earning money. This is because if I counted the pips earned, I would still be at a loss, but by considering the monetary value of the pips earned, my performance will consistently be in profit. Therefore, it's not as you've always been told. Just because you earn points from the market and always predict the market trend correctly doesn't mean you will make a profit. If you lose the concept of earning from your trading, even if you don't make any wrong entries, you are actually missing out on profit opportunities, because compared to the opportunities where you could earn, you end up earning less. I will show you this with another account. Here, as we've seen previously, the trader has handled market adversity well. Despite the losses, the difference between pips and gains is managed effectively. However, at this other point, the trader is earning more points in the market compared to the potential returns. In practice, the trader's activity in that situation is underpaid. You can immediately verify this concept. Suppose we consider a case with an account in terms of pips, assigning a unique and equivalent value to each pip. What trend will my equity follow? It would follow this trend. For every pip lost, my equity will follow the same pattern. If I set a multiplier for each pip gained after the loss, what would happen to my equity? Compared to the previous case, even though I am losing points in the market, I am actually gaining. If I tripled the multiplier, I would achieve greater performance. On the market, I lose points, but meanwhile, I am earning money. But what if I have the multiplier? I would underperform the market. So what's the solution? Double? Should we grid or average all losing trades? Absolutely not. In fact, in the jMathFx context, the options to average, double, or grid on the same currency pair are disabled. So, how can I recover losing trades without doubling, averaging, or grid trading, which exponentially increases the risk of worsening my exposure? It's time to consider a new approach that doesn't rely on precise trend predictions or traditional solutions that jeopardize account balance in case of loss. This involves a more sophisticated understanding of market exposure through new tools and rules that enable extraordinary results even when market dynamics are not perfectly interpreted. Many believe that without understanding the trend, it's impossible to recover losses. However, this reasoning is limiting. Even if the first trade is wrong, there are several methods to easily recover losses with a high probability of success. The key to success in trading isn't to avoid losses entirely, but to manage them effectively using innovative measurement techniques and tools. A loss, if managed correctly, can become a profit opportunity just as much as correctly identifying market trends can lead to losses. However, having tangible proof that losses hide an opportunity to make money can be extremely dangerous if you're inspired to rush into the market with the idea of improvising recovery techniques in adverse situations. To recover losses and make money at the same time, you need useful tools that provide an overview of the impact of your actions on the market. Before entering the market, you should at least ensure you understand the scenario you will soon face. Adequate information is needed to guide you on what to evaluate during the most critical phases of the financial problem you need to solve. This requires study, preparation, and, above all, tools. You need a track record of irrefutable recovery evidence, not just lucky breaks. Recovering some losses does not mean you're prepared to recover accounts and profit in every market situation. Trust in your market actions comes when your operational techniques are successfully tested on various accounts over a period longer than a year. There's work behind being able to face the market in any context and thus be ready to leverage losses. Otherwise, if you rush into the market, convinced you can replicate what was just shown in this video, you risk further worsening your market exposure in scenarios that, if not properly understood, can create losses far beyond the available balance in your account. Many brokers do not protect against negative balances, so it's important to verify this before working with them. Be cautious in the market, as there is a very high probability of incurring losses far greater than those you anticipate when attempting to recover. Besides the fact that you also risk wasting time and money under the illusion of finding solutions unproven over time, which will expose you to significant financial risks. Alternatively, there's always the possibility of closing losses before they become unmanageable. It's still a method that in the long run can give you the ability to withstand market uncertainties despite incurring losses. However, the opportunity to exploit adverse market conditions to make money should not be underestimated. This video and the results it contains are proof, but be aware that the market is risky. And if inspired by the fact that you've seen someone do possible things, it doesn't mean you're able to replicate it. To make the impossible possible, preparation is needed that goes above any standard level. There are studies, there are calculations, there are tools, there is a logic compared with mathematical rigor. In short, there is a volume of information that, due to time constraints, it was not possible to cite and report in this video. However, I have good news for you. If you were interested in delving deeper into this aspect of the market, discovering new techniques to maximize your market performance, leveraging losses, in short, learning to apply techniques and methods through innovative and cutting-edge tools dedicated to detailed analysis of your exposure, an educational program is in preparation. Loss Management Revolution. This course will provide you with advanced tools to measure and manage risk with precision. It will give you the opportunity to learn proven techniques and methods to transform losses into profit opportunities. Because there's also the possibility that a loss cannot be recovered, and therefore it's necessary to understand this before venturing into a market situation where, convinced you can recover, you end up with further problems. Not all losses can be recovered. Some must necessarily be closed, and when you're able to identify them, you'll be happy to close them. So it's necessary to know how to distinguish good losses from bad ones. Additionally, you'll also learn methods to maintain emotional control even in the most stressful situations. That is, educating your mind to look for small feedback in the market that will offer you confirmation of your actions so as to keep you calm and relaxed with a clear mind in facing with the right detachment market opportunities that are certainly risky but highly profitable. In short, behind this possibility presented in this video, there's much more to know. Important information, tested over time, that will help you understand aspects of the market and your own exposure that the majority of operators are still unaware of. The educational program is currently under development, but is being offered in pre-sale at this time. So you'll have the opportunity to get it at a steep discount if you book it in advance. Attached to this video, you'll find all the information you need. The jMathFx method differs from traditional methods of the old-time price paradigm. We are able to show you how to exploit market opportunities in a purely mathematical context, therefore indisputable. Today, you have the opportunity to maximize your performance without excessively increasing risk by exploiting market situations, such as losses, which the majority of operators experience passively because they are unable to manage. We are finalizing this educational program for all those who wish to do things that others are not even able to understand. This means standing out, and in a context where 90% of operators lose in the market, standing out becomes the most important rule to follow. Today, you are offered a unique opportunity to access knowledge not yet disclosed, which can really make a difference in your approach to the market. In this program, the ability to predict trends takes a back seat. With the right tools and appropriate strategies, you have the possibility to perform in any market condition while having full control of your risk management. Check the information attached to this video to be one of the first to access this exclusive program. See you on the other side, ready to embark together on this exciting journey into an advanced trading concept.